Should you invest now or wait for the next stock market crash? This is the age-old debate between time in the market and timing the market. If you have cash on hand and are looking to invest when the stock market is at near all-time highs, is it a good idea to invest now or wait for the next inevitable stock market crash? I mean, we all want to make the highest amount of returns with our investment, so what's the right decision? In order to answer this question, it's first important to understand the history of the stock market and the story it tells us. What the facts tells us is that the S&P 500 index, which is the benchmark of American stock market performance, has returned a historic annualized average return of around 10% since its inception. But has the stock market crashed and never recovered? The stock market has always eventually recovered. As a matter of fact, history tells us that your chances of profiting from investing in the S&P 500 are 73% in any given year. And something even better to note is that since 1950, the S&P 500 has undergone 38 official stock market corrections, and it has still continued to march on higher and eclipse new records. But if you were not invested in the stock market and you were instead waiting on the sidelines for the next stock market crash, you would have missed out on these gains. The truth of the matter is that there are natural peaks and valleys in the economic cycle, and no one can accurately predict the next stock market crash, not even the most well-researched and intelligent financial professionals. Take, for example, the famous American financial newsletter writer Harry Dent Jr. His high-profile book, The Great Depression Ahead, appeared on the New York Times bestseller list in 2009 despite his hit-and-miss predictions on the direction of the economy. In 2013, Dent famously predicted the market would crash in the summer of 2013 and take a further year and a half to recover. The stock market actually went on to excel and hit new highs for the next 2.5 years before it eventually crashed again in 2016. If you had taken his prediction as truth and waited for the 2013 stock market crash that never came to pass, you would have lost a considerable amount of gains during that time. And even if you were fortunate enough to have invested at the bottom of the 2016 crash, you still would have purchased stocks at much higher prices than if you were to have bought those same stocks back in 2013. So if experienced financial experts can't accurately predict the next moves of the stock market, how do you think the normal everyday investor will do in predicting the next stock market crash? Warren Buffett has a famous quote in reference to these stock forecasters that reads, "We've long felt that the only value of stock forecasters is to make fortune tellers look good." And so far, his belief has been a quite accurate reflection of stock market forecasters. So far, there is some fairly compelling information leaning towards investing now versus waiting for the next stock market crash. But before we make a decision, let's take a look at a couple of other things, including the two most recent stock market crashes. Despite 2020 being a year like no other, with a heart-pounding 30% drop in the index in mid-February, which lasted through mid-March, the S&P 500 actually set 33 new records and ended the year with an 18.4% total return. The huge stock market crash lasted barely a month. And then there was also the 2008 financial crisis. While the index didn't recover as quickly as the most recent crisis we faced, it did still indeed recover. The S&P 500 peaked on October 11th of 2007, right before the market crash. If you had invested in the index at its height in October, it would have taken you nearly 4.5 years to recoup your losses and another year before the S&P 500 would hit another new high in April of 2013. Your cumulative return during this 5.5-year span would be 14%. So even if you were to accurately predict the next stock market crash, you would still need to make another very important prediction. When will the stock market bottom out in order for you to buy at the most favorable prices? Get either one of these answers incorrect and you'll miss your opportunity. Now that's a lot of pressure, wouldn't you say? Still, one of the greatest reasonings behind not trying to time the market is because you won't actually buy when the time does come. If you're like most people, you'll sit in the middle of the crossroads like a deer caught in the headlights, frozen in fear with all the blood in the stock market streets. Most people view buying at the bottom of a huge drop like catching a falling knife, one that may very well cut much deeper if prices continue to fall. Consequently, most people will miss their opportunity to buy at rock bottom prices. Again, let's take, for example, March 12th of 2020, when the stock market experienced a gut-wrenching 10% drop in one day. That was your chance to buy. But people's worst fears of the market crashing even further for an extended period of time prevented most from buying. The S&P 500 did in fact continue to fall, but shortly after, within about a month's time, the market slingshot back up so quickly that if you didn't buy in that short window, you would have lost your opportunity to get in on one of the greatest stock market comebacks we've seen in a very long time. Now, before I share with you how affluent millionaires invest their money in the stock market during all-time market highs, let's first hear the opinions of two prominent and well-known investors about timing the market. Here's what Peter Lynch, American investor and the most successful manager of the best performing mutual fund in the world, has to say about trying to time the market.
The stock market's a very good place to be, but I can toss a coin now. Is it going to be lower 2 years from now? Higher? I don't know. More people lost money waiting for corrections and anticipating corrections than the actual corrections. Well, you ought to look in the mirror every day and say, what am I going to do if the market goes down 10%? What am I going to do if it goes down 20? Am I going to sell? Am I going to get out? If that's your answer, you should be reducing it today.
And here is billionaire investor Warren Buffett's opinion on the issue at hand.
There's so many variables. I mean, in the hard sciences, you know that, if an apple falls from a tree, that it isn't going to change over the centuries because of anything or political developments or 400 other variables that go in. But when you get into economics, there's so many variables. And the truth is, you've got to expect good times and bad times in business. And if you were to buy an auto dealership and you're, wherever you live locally, or a McDonald's franchise or anything like that, you wouldn't try and time the purchase. You'd try and make the right purchase at the right price, and you want to be sure you got a good business. But you wouldn't say, I'm going to buy it because growth this year is going to be 3% instead of 2.8% or something of the sort.
Fair enough.
So how should you invest when the stock market is at an all-time high? The answer is pretty simple. You find underpriced stocks where there is better opportunity to grow your investment. And that's exactly what some of the most affluent investors are currently doing, according to a recent CNBC report. Millionaire investors are making portfolio changes to reflect where the market is most pricey, such as in large cap US stocks, and where stocks are underpriced, including internationally. In my monthly stock pick videos, I actually share with you many of these underpriced stocks where there is plenty of opportunity for huge potential gains. If that's information you're interested in receiving, then definitely make sure to subscribe to my channel and hit that notification bell for when I post these videos. While it is impossible to predict a stock's future outcome, one can make educated decisions on buying good companies at undervalued prices, no matter what the current market conditions are. But trying to time the market for the next market crash may actually end up costing you more money than if you were to invest right now. Ultimately, one of the best ways to keep your stock portfolio bulletproof tight is to not be an emotional investor and to hold your investments for long-term gains. If you've enjoyed watching this video, then please do me a quick favor and hit that like button, as well as subscribe to my channel. I'll see you again in the next one. Take care. Bye-bye.